Global Business Today, Charles Hill and Thomas Holt, Chapter 7, Government Policy and International Trade. In this chapter, we are going to identify the policy instruments used by governments to influence international trade flows, understand why governments sometimes intervene in international trade, summarize and explain the arguments against strategic trade policy, describe the development of the world trade system and the current trade issue, and explain the implications for managers of developments in the world trade system. The opening case highlights a negotiation of a trade deal between the United States and Kenya. Some current Chinese projects, including those in Kenya, have left African governments saddled with billions of dollars in debt to China. They have also sparked distrust and resentment at China, which has often used Chinese companies and managers to complete the projects. This makes the African countries believe that this is a neo-colonialism tactic that China is using. It hasn't helped China's case that some of the managers, Chinese managers, have been caught on phone videos making racist comments to their African workers. So why Kenya? Why has the United States decided to engage in negotiation agreement with Kenya? Kenya has emerged as a bright spot in Africa. Its strong economic growth over the past few years is expected to actually continue. It has a relatively well-educated workforce and a spirit of entrepreneurship, and it is the financial and transportation hub for East Africa. While the proposed free trade agreement with the United States will likely barely register in America because Kenya is a small country, in Kenya, it will provide continued access to an important trade partner. This trade agreement is currently being reviewed by the Biden administration, actually. But there are other agreements in place, and Kenya qualifies for duty-free access until 2025 to the US market and the African Growth and Opportunity Act. Some of Kenya's major products that qualify for this benefit for export under the AGOA include textiles, apparel, and handicrafts. The theories of Smith, Ricardo, and Heckscher Olin that we have been discussing in previous chapters predict that the consequences of free trade include both static economic gains, because free trade supports a higher level of domestic consumption and more efficient utilization of resources, and a dynamic economic gain, because free trade, stimulates economic growth and the creation of wealth. On October of 1947, the General Agreement on Tariffs and Trade, the GATT, was signed by 23 nations at the Palais des Nations in Geneva. The first learning objective is to identify the policy instruments used by governments to influence international trade flows. Tariffs are the oldest and simplest instrument of trade policy. We're going to take a look at the rest. In the USA, the government received most of its revenues from tariffs until the first income tax was introduced. And when did that happen? Well, the financial requirements of the Civil War prompted the first American income tax that was levied in 1861. At first, Congress placed a flat 3% tax rate on all income over $800. And then later on, it modified this principle to include a graduated tax. So what are tariffs? It's a tax levied on imports that effectively raises the cost of imported products relative to the domestic products. There are specific tariffs and ad valorem tariffs. In most cases, tariffs are placed on imports to protect domestic producers from foreign competition by raising the price of imported goods. However, tariffs also produce revenue for the government, as we just saw. That was the main source of income until 1861, at least for the United States. Specific tariffs are computed on the physical quantity of the good being imported. Australia's 2005 schedule includes a tariff of $1.22 per kilo on certain types of cheeses, and the United States charges 68 cents per live goat that is imported. The physical quantity may be expressed in ways that are difficult to determine without laboratory equipment. The European Union charges duties on certain dairy products based on the weight of lactic matter in the product, and the United States charges a tariff on raw cane sugar that varies with the sucrose content of the sugar. Mixed tariffs are expressed as either a specific or an ad valorem rate. So the ad valorem levies a portion of the value of an imported good. So depending on that value, generates the most or the least revenue. For example, in India, there are duties on certain rayon fabrics, and they're either 50% of ad valorem or 87 per square meter, whichever is higher. Compound tariffs include both an ad valorem and a specific component. For example, in Pakistan, they charge 88 cents per liter of some petroleum products, plus 25% ad valorem. Tariff rate quotas are made up of a low tariff rate on an initial increment of imports within quota quantity, and a very high tariff rate on imports entering above that initial amount. As mentioned before, tariffs increase government revenues. They also provide protection for domestic producers, so they are pro-producer and anti-consumer as they increase the value of the product that is being imported. Import tariffs reduce the overall efficiency of the world economy. Sometimes tariffs are levied on exports of a product from a country. Export tariffs are less common than import tariffs. In general, export tariffs have two objectives. First, to raise revenue for the government, with regular tariffs, and second, to reduce exports from a sector, often for political reasons. Subsidy. So what is a subsidy? It's a government payment to a domestic producer that subsidizes and helps the domestic producer to either compete against low cost foreign imports or gain export markets. So subsidies take many forms. They include cash grants, low interest loans, tax breaks, and government equity participation in domestic firms. There are concerns that China's government subsidizes Chinese producers of autos and auto parts. So US lawmakers have raised concerns that the subsidies are unfair, of course, and they have filed a complaint with the World Trade Organization, arguing that subsidies have effectively hurt the US auto and auto parts producers. While some in the US auto industry support the complaint, there is those that have investments that are afraid that their investments in the Chinese market will be affected or damaged. So whether subsidies generate national benefits that exceed their national cost for China is debatable. In practice, Many subsidies are not that successful at increasing the international competitiveness of a domestic product. Rather, they tend to protect the inefficient and promote excess production. There are other barriers to trade, which are non-tariff based. Import quotas and voluntary export restraints, for example. So an import quota is a direct restriction on the quantity of some good that may be imported into a country. A tariff rate quota is hybrid of a quota and a tariff. A lower tariff is applied to imports within the quota than those over the quota. So we're using another way of creating a barrier. Voluntary export restraint. It's a quota on trade imposed by the exporting country, typically, though, at the request of the importing country's government. So is it really voluntary or is it enforced, right? It's forced. Quota rent is the extra profit that producers make when supply is artificially limited by an import quota. So import quotas and voluntary export restraints benefit domestic producers by limiting import competition. But they raise the prices of imported goods for consumers. So a little history on voluntary export restraints. Voluntary export restraints have been historically used on a wide variety of traded products. And in the US, they have been used since the 1930s. For example, the US-based producers of textiles faced increasing competition from Southeast Asian countries in the 1950s and the 1960s. So the US government requested VERs to be established by many of the Southeast Asian countries and was successful in doing so. So textile producers in Europe faced similarly stiff competition as their US counterparts, and as a result, they negotiated voluntary export restraints as well. Eventually, an agreement was reached between the exporting and importing parties within the textile industry that led to the formation of the Multi-Fiber Agreement in the 1970s. The agreement was essentially an arrangement of multilateral voluntary export restraints. The agreement is no longer in effect and was terminated in 2005 after the expiration of a 10-year transition period since the 1994 GATT. So the effectiveness of the VER, studies conducted on the effectiveness suggest that they're not effective over a long term. An example is the voluntary export restraints imposed by Japan on the export of Japanese manufactured cars into the US. The US government wanted to protect its automobile manufacturers since the domestic industry was threatened by the cheaper and more fuel-efficient Japanese automobiles. The restraint proved to be ineffective. What did Japan do? The Japanese automotive producers established manufacturing plant facilities in the US. Additionally, the Japanese car manufacturers started exporting more luxurious cars in order to generate adequate funds while still adhering to the export limitations set by its government. What is quota rent? A quota is a type of trade restriction where a government imposes a limit on the number or the value of a product that another country can import. For example, a government may place a quota limiting a neighboring nation to importing no more than 10 tons of grain. Each ton of grain after the 10 tons incurs a 10% tax, and that is the gain. Illustrated in this graphic, we see an ad valorem tariff rate of 10% that might be levied on 1 million tons of rice imports into South Korea, after which an out-of-quota rate of 80% might be applied. Thus, South Korea might import 2 million tons of rice, 1 million at a 10% tariff rate, and another million at an 80% tariff. Tariff quota are common in agriculture, where their goal is to limit imports over that quota. Again, keep in mind that this is pro-producer and anti-consumer. We mentioned export tariffs, which are very rare, and the goal is to discriminate against exporting a certain good to ensure that there is supply within the domestic market. Or an export ban, which is a policy that partially or entirely restricts the export of a good. For example, the ban of exports of U.S. crude oil that started in 1975 to ensure sufficient supply of domestic oil here in the United States. That was lifted in 2015. We have other examples. In the past, China has placed an export tariff on the export of grain to ensure that there is sufficient supply in China. Similarly, during its infrastructure building boom, China had an export tariff in place on certain kinds of steel products to ensure that there was sufficient supply of steel within the country. The steel tariffs were removed in the in 2015 because most countries try to encourage exports. Export tariffs are relatively rare. Another barrier in trade can be seen in the local content requirement, which demands that some specific fraction of a good be produced domestically. Can be in physical terms or in value terms. So this is the fastest growing trade barrier, which these measures of local content requirements, which are policies imposed by the government, and they require firms to use domestically manufactured goods or domestically supplied services in order to operate in that particular economy. There has been a substantial increase in the use of these measures in recent years as globalization takes form, as governments try to achieve a variety of policy objectives that target employment, industrial, and technological development goals within their land. A little known law in the United States, the Buy America Act, specifies that government agencies must give preference to American products when putting contracts for equipment out to bid, unless the foreign products have a significant price advantage, which rarely happens, right, when it comes to the government. So the law specifies a product as American if 51% of the materials by value are produced domestically. This amounts to a local content requirement. So often you may buy a car that says made in the USA when actually the car was assembled in Mexico and only 51% of that vehicle has parts that were made in the United States. Administrative trade policies are bureaucratic rules designed to make it difficult for imports to enter a country. So they hurt consumers, again, by denying access to possibly superior foreign products. It has been argued that the Japanese are the masters of this trade barrier. In recent decades, Japan's formal tariff and non-tariff barriers have been among the lowest in the world. However, critics charge that the country's informal administrative barriers to imports more than compensates for these low tariffs. For example, previous to 1988, tulip bulbs were quarantined and inspected by cutting the bulbs to ensure the absence of pests, ruining the bulbs. So that limited the availability of the bulbs. The plant quarantine measures for tulip and lily bulbs was abolished in 1988. A removal of the quarantine made Japanese bulb growers face international competition in the markets. France used to impose a quarantine of electronic goods that were imported from international markets. The 6 to 12 month inspection rendered the products outdated by the time they hit the market. Therefore, it was a barrier to the import of electronics. Anti-dumping policies and why they're necessary. So dumping is, what is it? It's selling goods in a foreign market below their cost of production or below their fair market value. And anti-dumping policies, which vary from country to country, are a way to protect domestic producers from unfair competition by levying what is called countervailing duties. U.S. firms believe that a foreign firm is dumping can file a complaint with government agencies like the Commerce Department and the International Trade Commission. So dumping is viewed as a method by which firms unload excess production in a foreign market. So some dumping may be the result of predatory behavior, with producers using substantial profits from their home markets to subsidize prices in a foreign market with a view to driving indigenous competitors out of that market. So once this has been achieved, so the argument goes for predatory behavior, the predatory firm can raise prices and earn substantial profits. The textbook has the case on protecting U.S. magnesium. The case explores the dumping charges levied by the U.S. magnesium against Chinese and Russian producers. So according to U.S. magnesium, the sole American producer of magnesium, Russian and Chinese producers were selling magnesium significantly below market value in an effort to drive U.S. magnesium out of business. The company filed a complaint with the International Trade Commission, the ITC, which ultimately ruled in favor of U.S. magnesium. We have another example of anti-dumping policies. In 2006, President Obama announced that he would impose a 35% tariff on automobile and light truck tires imported from China. The decision was a major victory for the United Steelworkers, the union that represents American tire workers. This countervailing duty was reviewed and reduced in 2019. But in 2021, the Department of Commerce and the International Trade Commission decided that revocation of the anti-dumping duty and countervailing duty would lead to a continuation of dumping by China. Thus, a countervailing duty still remains, and it was never revoked. The second learning objective for this chapter is to understand why governments sometimes intervene in international trade. So we have political arguments that protect the interests of certain groups, usually the producers, and often at the expense of certain groups, which are the consumers. And another reason is to achieve some political objectives, such as protecting the environment or human rights, or maybe some other political interest. And then there is the economic arguments, which is boosting the overall wealth of a nation to the benefit of both the producers and the consumers. Political arguments for intervention then includes protecting jobs, national security, or retaliation. And let's take a look. Protecting jobs and industries is the most common political reason for trade restrictions, which is an economic interest, right? So the national security argument is less common today than in the past. When the Trump administration announced tariffs on imports of foreign steel and aluminum in 2018, national security issues were cited as a primary justification. This was the first time since 1986 that a national security threat was used to justify tariffs imposed by the United States. In 2017, the United States was importing about 30% of steel used in the country, with the largest source of imports being Canada and Mexico. Interestingly, and counter to the argument of the Trump administration, critics argued that by raising input prices for many U.S. defense contractors, who tend to be big consumers of steel and aluminum, the tariffs would actually harm the U.S. defense industry and have a negative impact on the national security. So in continuing with the case for government intervention, protecting consumers, banning unsafe products, or furthering foreign policy objectives like granting preferential trade terms to a country it wants to build a relationship with, or pressure or punish rogue states, are also part of government policy and intervention protecting human rights. So there are other countries can undermine unilateral trade sanctions. The US sanctions against Cuba, for example, did not stop other Western countries from trading with Cuba. The US sanctions have done little more than help create a vacuum into which other trading nations such as Canada, Germany, Russia have actually stepped in. The infant industry argument. This argument has had substantial appeal for the governments of developing nations during the past 50 years. And the GATT, the General Agreement on Tariffs on Trade, has recognized the infant industry argument as a legitimate reason for protectionism. There are many reasons, for example, that the Boeing industry has survived from innovation to agility under pressure and competition, but government contracts and government subsidies have kept this once infant industry afloat. So it's also important to consider that. So strategic trade policy, appropriate actions by governments can help raise national income if it can ensure firms that gain first mover advantage in an industry are domestic, like in the case of Boeing. If these arguments are correct, they support a rationale for government intervention in international trade. Governments should target technologies that may be important in the future and use subsidies to support development work aimed at commercializing those technologies. Furthermore, government should provide export subsidies until that domestic firm has established first mover advantage in the world market. Government support may also be justified if it can help domestic firms overcome the first mover advantages enjoyed by foreign competitors and emerge as a viable competitor in the world market. Let's take a look at the Boeing and Airbus fight that lasted for many years. The dispute between the US and the EU escalated over many years, over 17 years, with both sides accusing the other of unfairly propping up their flagship plane makers. In 2019, the World Trade Organization ruled that the EU had illegally provided support to Airbus, clearing the way for the US to respond with tariffs worth up to $7.5 billion or 5.4 billion euros in annual trade. Roughly 1 year later, in a parallel case, it ruled that the US benefits to Boeing also violated trade rules. authorizing the EU to hit the US with tariffs worth roughly $4 billion. Since then, both sides have taken steps to remove the assistance found at fault. This way, we see that these kinds of war are not win-wins, but rather lose-lose situations. So our third learning objective is to summarize and explain the arguments against strategic trade policy. So we have the new trade theories that believe government intervention in international trade is justified. And then we have the classical trade theorists that disagree, like Adam Smith and David Ricardo. So some new trade theories believe that while strategic trade theory is appealing in theory, it may not be workable in practice. They suggest a revised case for free trade. So let's take a look. So Paul Krugman may be right about the danger of strategic trade policy leading to a trade war, like we just saw with Airbus and Boeing. The problem, however, is how to respond when one's competitors are already being supported by government subsidies. Domestic policies is when governments can be influenced by special interest groups, which this happens quite a bit. The European Union's support for the Common Agricultural Policy, which arose because of the political power of French and German farmers, is an example. The CAP, as the Common Agricultural Policy is known, benefits inefficient farmers and the politicians who rely on the farm vote, but not consumers in the EU who end up paying more for their foodstuff. Let's be fair here, the European Union is not the only country to subsidize the agricultural industry. It's a well-known fact that the United States does and many, many other nations do as well. And the reason for that is usually related to the fact that food is essential for a country to stay alive, for their people to stay alive. If they go into war, feeding their armies is a protection in being able to have the strength to go into war. So there are many other thoughts that come into place when it comes to agriculture. Our fourth learning objective is to describe the development of the world trading system and the current trade issue. Economic arguments support unrestricted free trade. We've been talking about this for a while now. While many governments have recognized the value of these arguments, they have been unwilling to unilaterally lower their trade barriers for fear that other nations might not follow suit. So let's take a look at what has happened in the world. After World War II, we had the initiation of the General Agreement on Tariffs and Trade, which was actually enacted in 1947. The main purpose of the GATT was to lower trade barriers and to help the world recover after the war. Since 1995, the framework has been known as the World Trade Organization, or the WTO. The development of the world trading system, taking a look from Smith in the 1700s to the Great Depression in the 1930s. So free trade as a government policy was first officially embraced by Great Britain in 1846, when the British Parliament repealed the Corn Laws. The Corn Laws placed a high tariff on imports of foreign corn. The objective of the Corn Law tariff was to raise government revenues and to protect the British corn producers. There had been annual motions in Parliament in favor of free trade since the 1820s, when David Ricardo was a member of Parliament. However, agricultural protection was withdrawn only as a result of a protracted debate when the effects of a harvest failure in Great Britain were compounded by the imminent threat of famine in Ireland. Faced with considerable hardship and suffering among the populace, Parliament narrowly reversed its long-held position. During the next 80 years or so, Great Britain, as one of the world's dominant trading powers, pushed the case for trade liberalization, but the British government was a voice in the wilderness. Also in the 1930s, during the Depression, the Smoot-Hawley Act created significant import tariffs on foreign goods, which damaged employment abroad. Other nations took similar steps, and as the Depression deepened, world trade fell even further. So these kinds of protectionist policies do not create a win-win. The General Agreement on Tariffs and Trade, known as the GATT, traces its origins to the 1944 Bretton Woods Conference, which laid the foundation for the post-World War II financial system and established two key institutions, the International Monetary Fund and the World Bank, which we are going to study more in detail later on. The conference delegates also recommended the establishment of a complementary institution, which at the time was going to be known as the International Trade Organization, or ITO, which they envisioned as the third leg of the system. The ITO never came to fruition. Nevertheless, in its early years, the GATT was, by most measures, very successful. For example, the average tariff declined by nearly 92% in the United States between the Geneva Round of 1947 and the Tokyo Round of 1973 to 1979. So consistent with the theoretical arguments first advanced by David Ricardo, the move toward free trade under the GATT appeared to stimulate economic growth, not just for the US, but all around the world. But it lacked the formal structure that was later conceived as the World Trade Organization. So let's take a look. So what happened between the 1980s and 1993 that caused the GATT to actually be transformed into the WTO? We started to see protectionist trends in the world. So the trading system erected by the GATT came under strain as pressures for greater protectionism increased. One of the issues that was seen as an issue at the time was that Japan's economic success strained what had been more equal trading patterns. Persistent trade deficits by the US caused significant problems in some industries and political problems by the government. Part of this was actually a result of the debt that had grown during the Vietnam War conflict. And many countries found that although the GATT limited the use of tariffs, other forms of intervention had the same effect, but did not technically violate the GATT. So bilateral voluntary export restraints, for example, the VERs, circumvented the GATT agreements because neither the importing country nor the exporting country complained to the GATT bureaucracy in Geneva. And without a complaint, the GATT bureaucracy could do nothing. Finally, the Uruguay round dragged on for 7 years before an agreement was reached on December 15, 1993, and it went into effect July 1st, 1995. The Uruguay round contained the following provisions. Tariffs on industrial goods were to be reduced by more than 1/3. and tariffs were to be scrapped on more than 40% of manufactured goods. Average tariff rates imposed by developed nations on manufactured goods were to be reduced to less than 4% of value, the lowest level in modern history. Agricultural subsidies were to be substantially reduced. The GATT Fair Trade and Market Access rules were to be extended to cover a wide range of services. GATT rules also were to be extended to provide enhanced protection for patents, copyrights, and trademarks, so including intellectual property that previously were not there. Barriers on trade in textiles were to be significantly reduced over 10 years. The World Trade Organization was to be created to implement the GATT agreement, and that is how the World Trade Organization was born in 1995. Now we have an enforcing organization that helps countries to discuss and to deal with their differences when it comes to trade. We see today that the members of the World Trade Organization account for 98% of world trade. So that's most of it. So 164 countries are members. China joined in 2001, Russia joined in 2012. And we have 25 countries that are considered observers. So they're not part of the WTO, yet they can be considered in looking at how the decisions work and see if they eventually can join into the World Trade Organization. Truly, it was hoped that it would emerge as an effective advocate and facilitator of future trade deals, which actually has happened. But protectionism tendencies may affect its efficacy. We see that Brexit actually has taken place now almost 2 years ago. And just like Britain is demonstrating protectionism, the United States had an administration that was also showing protectionist tendencies. And this could actually spread to other countries. If this is the case, then we're going to go back to what happened in the 1930s, which was not positive. So we see that the World Trade Organization can act as a global police when it comes to trade. 70 countries agreed to dramatically lower or eradicate barriers to foreign direct investment in their financial services sectors. The United States and the European Union, with minor exceptions, are fully open to inward investment by foreign banks, insurance, and securities companies. As part of the deal, many Asian countries made important concessions that allowed significant foreign participation in their financial services sectors for the first time. In fact, this was one of the painful results for Britain exiting the EU. A lot of the financial services that were established in London actually moved to Europe, to France and to Germany, because of the restrictions that they would have to endure as part of that separation of Britain from the EU. So this has caused the EU great pain when it comes to financial services. Some of the unresolved issues from the Doha round and from the Uruguay round, one of those issues was protectionism in agriculture. We do know that there was a goal to actually lower tariffs and protectionist tendencies on the agricultural sector around the world, but we haven't seen much progress in that area. Anti-dumping actions, they were to encourage members to strengthen regulations governing the imposition of anti-dumping duties, and that has been in place. We have seen, for example, in the situation with Airbus and Boeing, how they actually reduced those anti-dumping levies that they placed on each other. And protection of intellectual property, members believe protection of intellectual property rights is essential to the international trading system. So this is something that has been inactive, and WTO members, based on the TRIPS, are to grant and enforce patents lasting at least 20 years and copyrights lasting 50 years. As mentioned earlier, the historical high tariff rates on agricultural products reflect a desire to protect domestic agriculture and traditional farming communities from foreign competition. In addition to high tariffs, agricultural producers also benefit from substantial subsidies, and that's not just unique to the United States. This is an issue that happens worldwide. As of 2018, the goal for the Doha round was to reduce tariffs for manufactured and agricultural goods by 60 to 70% and to cut subsidies to half of their current level. But getting nations to agree to these goals has proved to be quite difficult. In response to the apparent failure of the Doha round to progress, many nations have pushed forward with multilateral or bilateral trade agreements, which are reciprocal trade agreements between two or more partners. For example, in 2014, Australia and China entered into a bilateral free trade agreement. In late 2019, the Trump administration blocked the replacement of 2 judges on the WTO's appellate body, which hears appeals in trade disputes. With just 1 judge remaining, it will no longer be able to hear new cases, which effectively undermines the WTO's enforcement mechanism. The significance of these developments is that heretofore, both Britain and America have been leaders in the global push toward greater free trade. The Director General of the WTO is referring to the rise of tariffs, the ongoing trade dispute between the world's 2 largest economies, the United States and China, and the apparent belief of the Trump administration that bilateral agreements and managed trade deals are superior to the rules-based multilateral trade ordered embodied in the WTO. Now, as we have a new administration, some of these things may be changing in the near future, but nevertheless, these are concerns as mercantilist views really do affect the flow of free trade around the world. The last learning objective for this chapter is to explain the implications for managers of developments in the world trade system. So when trade barriers are targeted at exports from a particular nation, firms based in that nation are at a competitive disadvantage to firms of other nations. The firm may deal with such targeted trade barriers by moving production into the country, imposing barriers, like we saw in the example with the Japanese automakers. They ended up bringing Japanese manufacturing plants here to the USA. Another strategy may be to move production to countries whose exports are not targeted by the specific trade barrier. So another option could have been for Japan to go somewhere else and seek a different market. Very important to realize that tariff barriers raise the cost of exporting. Quotas may limit a firm's ability to serve a country. Firms may need to conform to local content requirements. Future trade barriers can influence firm strategy, which is important, especially when we look at the model that was established by the Porter's Diamond. And anti-dumping actions limit the ability to use aggressive pricing to gain market share. The opportunity for companies to lobby in their favor or in the favor of free trade in their countries is very important, and it is important because it affects not only their own company, but the consumer and world trade and other nations. Most economists would probably argue that the best interests of international business are served by a free trade stance, as we've been discussing for quite some time, but not a laissez-faire stance. It is probably in the best long-run interests of the business community to encourage the governments to aggressively promote greater free trade by, for example, strengthening the WTO. Business probably has much more to gain from government efforts to open protected markets to imports and foreign direct investment than from government efforts to support certain domestic industries in a manner consistent with the recommendations of strategic trade policy. The drawbacks to government intervention: self-defeating as it protects the inefficient, dangerous as it might invite retaliation from other nations, unlikely to be well executed as can be captured by special interest groups. We have the example, for example, of the tulip industry in Japan, which after 1988 opened the market and did away with quarantines of the tulip bulbs and inspections. And it opened the market to competitiveness, which actually, when there is competitiveness, it strengthens the growers within the nation to use more efficient methods to create and innovate. So free trade actually promotes innovation in the end, and it benefits both producers and consumers. So far, we have identified the policy instruments used by the governments to influence international trade flows. We have taken a look at governments and how sometimes intervention in international trade may be justified. We summarized and explained the arguments against strategic trade policy, described the development of the world trading system and the current trade issues, and we have explained the implications for managers of developments in the world trade system.